Hello and welcome guys, and welcome to the third part of the audit marathon. I hope you have done part number 1 and 2 pretty well, and you've completed the first 2 chapters. I know that you must have completed all the chapters by now, and this is just a revisionary session in which I'm going to make you go through the entire chapter in very quick manner and in a very short span of time. So today we are going to start one of the most important chapters of our syllabus, that is chapter number 3, which commands a weightage of about 8 to 10 marks in your examination. And the chapter 3 deals with internal control, internal check, internal audit, vouching and verification. So guys, in this chapter we are going to study the essential elements of internal control. Now, what is internal control? I've already given you a brief background of internal control in chapter number 2, whereby I had explained that internal control means even before the auditor visits the premises of the company, the auditor is supposed to check the internal controls which are already installed by the management of the company to curtail or to restrict errors and frauds in the financial statements. These are known as internal controls. So let's start the chapter. Now, as you can see on the screen, there is a diagram which shows that internal control has 2 elements: internal checks and internal audit. So internal control is employed by the management of the company to ensure that even before the auditor comes, the errors and frauds are minimal in a financial statement of an organization. Now, while ensuring that the errors and frauds are minimal, the management takes help of 2 things. Thing number 1 is internal check. Thing number 2 is internal audit. So both these things clubbed together forms the internal control, and if there is weakness in any of these 2 elements, then internal controls of that company is said to be weak. Now we need to analyze what is internal control, what is internal check, and what is internal audit. Let's start with internal check. Now guys, in layman terms, in absolute simple terms, internal check means a system whereby a transaction which is done by one of the employees is automatically checked by another employee. So I'll give you an example. In your examination, your teachers advise you to revise your paper before giving it to the examiner finally. Revise it once for 10-15 minutes. Guys, that last moment revision is an internal check which ensures that whatever you have written it perfectly. Because while you are writing it, you are prone to making many mistakes while writing a particular answer to a question. But when at the end of the paper, when you have finished the entire paper, your mind is at ease and it is relaxed. At that point in time, you tend to check or recheck your paper, and that rechecking is known as internal checking. So whenever a transaction is being entered into, the management forces the employees to cross-check that transaction several times so that no mathematical inaccuracy, no numeric inaccuracy, no factual inaccuracy creeps into the transaction, and the transaction is recorded pretty much perfectly. One of the most important ways of doing internal check is that work of one person should be checked by another person. So suppose an accounting entry has been put in the system by Mr. A. Now Mr. B should actually review the accounting entry which has been put by Mr. A, whether the accounting entry has been put as per the required standards, as per the required norms, as per the requisite policies which are installed by the company, and also to ensure that the transaction has been entered perfectly. There should not be any error while recording the transaction. This is one of the ways in which the management keeps control over the entire organization and the transactions which are being entered into. This is known as internal check. So the definition is, internal check is a system whereby work of one individual is checked by other. In the staff, internal check is a valuable part of internal control. So it is the first part of internal control, and it is really important for an organization to have a strong internal checking system. In other words, internal check is an arrangement of staff duties where no one is allowed to carry out and record every aspect of the transaction single-handedly. So this is a way in which the entire staff is required to divide its responsibilities into various people. So, for example, if in a banking transaction, the money is to be deposited into a bank, at that point in time, the organization will ensure that there are 2 or 3 people involved in the entire transaction. So selling is done by one person who collects the cash. Then the cash is given to the accountant who counts the cash and records it in the books of account. Then the third person is the person who is going to bank and depositing this cash in the bank. So in a way, a transaction is audited by 3 people, and that is how internal check works. When a transaction goes through the hands of multiple people, the possibility of errors and frauds are reduced. Now, what are the benefits of internal check? Benefits are it fixes responsibility of a particular act to a particular person. I mean, if suppose if accountant has not counted the cash properly or has not booked the entry properly, then we can easily fix the responsibility of not doing this on the accountant. Then obtain confirmation of facts and entries, physical, financial, by the creation and preservation of necessary records. The internal checks ensures that we have confirmed the facts, entries, all the documentation behind the entry, and everything is done properly. This is the benefit which is there if we are doing an internal check system properly. Then third is breakdown of routine procedures. All the procedures are broke down into small parts, and that segregation helps the organization to properly arrange its work, and the work does not get suffered if a person is absent. So if a person is absent, the other person knows that he is absent, and the work gets reallocated to the first person automatically. So this is the benefit of having internal check system in an organization. Then fourth is it reduces the chances of fraud and error. Of course, if 2-3 people are looking at one transaction, it will definitely reduce the chances of fraud and error. So these are the 4 benefits of internal check: fixes responsibility, obtain confirmation, breakdown of routine procedure, and reduce errors and frauds in a transaction. Then what are the duties with respect to internal check system of the auditor? Now the question arises that, sir, this is internal management's decision. What kind of internal check should be employed? What kind of internal control should be employed? This is management's discretion. This is management's prerogative. What does the auditor do with this? What is the role of the auditor in this entire scheme of internal check, internal control, and internal audit? Because statutory auditor, who's an outside party, has to perform the audit procedures to gain confidence on the financial statements. So what is his role, or what is his involvement in the internal check system of an organization? Now guys, let me tell you, the statutory auditor, he does not have a lot of time to do the audit. He merely would be provided, say, 3 to 4 months to complete the audit for the entire organization. So auditor does one very smart thing, and the smart thing is that he tests the internal controls. If internal controls are working fine, then the auditor reduces the intensity of the audit procedures which he employs, because he is reasonably certain that if internal controls are working fine, then all the transactions would have been recorded fine. So the auditor checks the internal control, checks the internal audit system, and checks the internal checks. And if he is confident that yes, all these things are working fine, then he gains confidence on the financial system of the entity, and then his workload reduces. He would employ less rigorous audit procedures. This is the benefit which auditor has of an internal control system. One more thing, auditor also has to report in his audit report whether the internal control system and whether the internal reporting framework and all the controls which are surrounding it are working absolutely fine or not. So for that reporting also, auditors need to check the internal check system. So let's come on to the theory, the text part. The auditor should apply a few test checks. That is, he should check a few transactions on a random basis, or check fully accounts for a few months and carry out through check of whole of certain class of transaction taking place during the particular period. So the advisory to the auditor is that he should check whether the internal control system is working fine or not. If the internal control system is working fine, then the auditor is in a very positive situation or a better position as compared to a situation where auditor finds loopholes in internal control system. The existence of a good internal check system reduces the work of the auditor but does not reduce his liability. Now, the auditor cannot stand up and say tomorrow that I had relied on the internal control system, my report was based on internal control system. Now, if there is a lapse in internal control system, it is none of my business. Auditor cannot say this, guys. Even if auditor relies on the internal control system of the management, the responsibility does not reduce. The liability of the auditor does not reduce. Auditor's responsibility was to check the internal control systems properly, and his responsibility was to ensure that they are working fine and then accordingly prepare his report. If the auditor had done some mistake in doing this analysis, tomorrow he cannot take a ground or claim that he was relying on the management's internal control system and hence his audit report was bad. He cannot take this shelter of internal control system. So the liability does not reduce even if the auditor chooses to rely on the internal control system. Now, what is a checklist? Checklist is usually a comprehensive list of all the aspects of internal check system designed to draw attention to important aspects of the system of internal check. Now, guys, checklist means it is a list of to-dos. It is a list of things which are to be done with respect to the internal check system and what kind of internal check systems are there. It is a comprehensive list, a big list, which highlights what are the parts of internal checks and what are the elements of internal checks. So this is a checklist which is drawn to make auditor aware about the internal check system, about the internal control systems which are existing in an organization. Now, what are internal control questionnaires? Internal control questionnaires are the internal check system questionnaire is a list of systematically and logically prepared questions designed to evaluate the effectiveness of internal check system. Now, what auditor does is auditor would prepare a questionnaire in which he would ask relevant questions to the management to ascertain whether the internal controls are proper or not and whether they are working fine or not. So we have also taken an example. Just see the example of an internal control checklist over here. So if you are in a restaurant and checking the cash receipts of that particular restaurant, and if you want to prepare an internal control questionnaire regarding the internal checks which are employed by the company or the restaurant, the questions you would ask is: accounting personnel are prevented from having access to cash, inventory and others. So guys, the person who's doing accounting is different and the person who's actually handling cash and inventory should be different. That is how two people will look at one transaction. So the first internal control question is that accounting person should be separate from the people who are actually on ground collecting cash from the customers or the guest. Then the cash deposits are made daily or as frequently as possible. The auditor has to ensure that the cash deposits are being made on a regular interval and daily or not. Then surprise cash counts are conducted regularly by bartender, cashier positions. So the cash count should be a general practice which should be followed by every organization, and the senior accountants, the bartenders or the cashiers should do surprise check for cash count. Then the cashier, servers, bartenders do not have access to their register totals. Now, the people who are doing cash count should not be having any access to the register of cash. I mean, if they have access to register of cash, then they would try to match the cash balance which they actually have with the register balance. This should not happen. The bartenders or the people who are handling cash should tell their balance to the finance people, and then finance people should check it with the register. If bartender would have cash register with them, then bartender would misappropriate the cash to siphon off the cash from the company, and that would not be a good situation. Then the fifth part is that the managers observe cash handlers and complete their checkout sheets and then provide amount due. The managers should keenly observe what is happening with their cash. They should check out the sheets, and then they should provide amount due in the cash book, which should have been in the cash book, to the bartenders or to the people who are collecting cash. So guys, this is the internal control question, type of internal control questionnaire which you will issue as a auditor to know. This is a prima facie evidence, the first evidence which you will gather to know whether the internal controls surrounding cash are working fine or not. Then the questionnaire are as comprehensive as possible to make sure that all aspects of accounting transactions are covered. So questionnaire should be very, very robust. Ask as many questions as you can, because to gain an understanding of a particular process is not easy. Hence the questionnaires should be comprehensive. During the course of audit, pre-commencement of audit, statutory auditors submit questionnaire to the management. Now, statutory auditor will submit the questionnaire to the management, and the managerial officers should respond to these questionnaires. The replies by the concerned official will help the auditor to form an opinion as to adequacy and reasonableness of internal check system. So by reading these questionnaires, the auditor will get a fair idea of whether the controls are working fine or not, or is the management misappropriating their assets or cash by using faulty internal control systems. This will be apparent from the internal control questionnaire. So next is an example of an internal control questionnaire of another area. Now this time the area is human resource function. The question which you will ask to the management is, are HR goals in line with those of the organization? Are the work weeks identified and defined? Are the full-time and part-time hours defined? Are the shifts defined? So these are certain questions which you will ask your HR department while checking the internal control system. Now the question arises, what is the difference between a checklist and an internal control questionnaire? So guys, first of all, the checklist is a guideline, set of guidelines which are to be followed by the audit staff. However, internal control questionnaires are the questions related to internal controls which are to be answered by the management of the company. This is prepared by the auditor, but it is to be answered by the management of the company. However, checklists are prepared by the auditors, and auditors only have to fill that checklist to ensure that nothing remains in an audit exercise. Point of time, the checklist is prepared and issued at the commencement of audit. However, the questionnaire are prepared and issued during the course of the audit. So checklists are formed even before audit starts. However, the questionnaires are formed during the course of audit as and when required. The checklist is issued to the audit staff, and the internal control questionnaire are issued to the management of the company. So checklists are relating to questionnaires, questions which are given to the audit staff so that they do not miss upon any important aspect of an audit. And the internal control questionnaire is for the management of the company to ensure that auditor understands the internal controls well. Objective is to set the guideline for audit staff so that nothing remains unchecked. And the objective of internal control questionnaire, it is used to collect information about the internal control system. Now the relationship between internal audit, internal control and internal check is that internal control is equal to internal check plus internal audit. So internal control is a wholesome exercise of controlling the errors and frauds in the financial accounts of an organization. And this is done using two techniques. One is internal check and second is internal audit. Now what is the difference between internal audit, internal control and internal check? This you will be able to appreciate very well now, because we have already discussed the basics of all these three things. Now I come upon to a very, very important aspect of auditing, which is the cut-off procedure. Now guys, as the word itself says, cut-off means to cut off between and set two things apart. So like if you cut a thread, then you make two threads out of one thread. So we cut certain things. Now sir, what are those certain things which we cut? Now to give you a live example guys, the business is carried on perennially. I mean year after year after year, business never stops. It just carries on perennially. However, it is the accountant who cuts the period financial year and make financial statements for a particular period only. because we cannot afford to prepare the financial statements after the organization ends its business and ends its entire system of working. We cannot afford to wait till that time. We cannot afford to wait till eternity to understand the financial position of a company. Hence, the auditors or the accountants cut the entire life of the business into small parts. Those small parts are the financial years in which the audit is conducted and in which the financial statements are made. So now when sales are going on and on and on, expenses are going on and on and on, it is really important to classify the expenses and sales in the respective period to which they pertain to. So for example, if you are creating financial statements of financial year 2019-20, then you need to ensure that whatever sales have occurred during financial year 19-20, they only should be recorded in the financial accounts of the financial year 19-20. And the sales which happens after 19-20 should not be recorded in the financial statement. This is what is to be ensured. And to ensure this, every auditor employs cutoff procedures. Now let us understand what are these cutoff procedures. These are adopted to allocate revenues and costs to the proper accounting period. Now to allocate the revenue and cost to the proper accounting period, we adopt these cutoff procedures. These are accounts payable and accounts receivable. These are the two accounts where mostly these procedures are employed, because these are most susceptible to any kind of fraud and error in the recording. So accounts payable and accounts receivable are typically categorized for using the cutoff procedure. Serially numbered documents like invoice for sale are allocated to the respective accounting period by establishing cutoff points based on the serial number. Now, this point you won't be able to understand, and if you want to understand this point, let us first come on to an example which is given as a class note. From the following extracts of sale register of Messrs Modern Paper Product Limited, you are required to ascertain which sales invoice should be recognized as income in the financial year 18-19. You may employ the suitable cutoff procedures. Now guys, these are the sales invoice number. 364, 65, 67 is missing, 68, 69. Sale invoice date. When was this invoice raised? 29th March, 30th March, 31st March, 31st March and 1st of April. Remember, we are dealing with financial year 18-19, which means sales which have happened in 18-19, which is March 31st, 2019. Before this date, all those sales should be recognized in the financial statements. Now, party name is AK Papers. 1 lakh rupees, goods, risk and rewards delivered on 30th March 2019. Now guys, remember one thing, revenues as per the accounting standards are to be allocated when risk and rewards are transferred, and not when invoice is raised, not when cash is received, but when risks and rewards are transferred, then only revenue should be recognized. So tell me, when should revenue of this particular 364 serial number be recognized? It should be recognized in the year financial year 18-19. Similarly, revenue should be recognized for these two invoices, 365 and 366, on 31st March 2019. So they should also be recognized in 18-19. Now comes on a case where the invoice was raised on 31st March, but the risks and rewards were transferred on 1st April. Guys, in this case, invoice date is irrelevant and you should recognize the revenue as per the date on which sales, the risk and rewards have been transferred, and that date pertains to financial year 2019-20. So this revenue should not be recognized in the year financial year 2018-19, but this revenue should be recognized in the year 2019-20. Next is the invoices raised on 1st of April and the goods, that is risk and rewards, are transferred on 2nd of April. Guys, in this case also the risk and rewards have been transferred on 2nd of April and the invoice is also raised on 1st of April. So the revenue is to be recognized in the year 2019-20. So this is how cutoff procedures work, and this is how we recognize revenue as per the cutoff procedures, that is risk and rewards, which are transferred. Then cutoff procedures require detailed testing by the auditor so as to ensure proper accounting of assets and liabilities which may arise without corresponding physical delivery of goods taking place. So cutoff procedure are also useful in determining when should an asset or liability be recognized in the books of accounts. Because guys, similar to revenue and expenses, the assets and liabilities are also to be recognized in the correct period. That is when they are capitalized, when they are put to use, these assets and liabilities should be capitalized. For example, purchase procedure involves a number of steps like issuing the purchase requisition, inviting quotation, selecting sellers, defining terms of purchase, entering agreement, receipt of goods, storage of goods, payment, etc. All the documents and vouchers are that substantiate the proof of authentication of these transactions are serially numbered. It is the auditor's duty to examine the cutoff points and ensure that transaction has been recorded in the period in which title in goods is transferred, irrespective of accounting period of physical delivery of goods, and to ensure compliance of Indian accounting standards and the relevant statute. So we understood by way of an example how does this system of cutoff procedure work, and this should be employed by every auditor to ensure that the right revenue is booked in the right period. Guys, otherwise revenue keeps on accruing. Sales keeps on happening. Sales doesn't stop when the year stops. Year is our prerogative, that is accountant's prerogative. Otherwise the business never stops. So this is the cut-off procedure, that is allocating the right revenue and cost to the right period. It is known as cut-off procedures. Now coming on to the next aspect, which is examination in depth or walkthrough test. Guys, in this concept, the auditor tries to gauge an insight into the entire transaction, because if auditor wants to audit a transaction, then he has to really go through the entire transaction properly, and he has to ensure that he understands the entire transaction well. So before the audit starts, what auditor does is, auditor on a test check basis pulls out certain transaction and sees it end to end. He would just see all the papers which are related to that transaction, so that he is able to understand the process, the steps which are taking place in that transaction. He understands that process well. This is known as examination in depth or walkthrough analysis. Steps of in-depth analysis: fixation of maximum tolerable error limit. So first of all, the auditor fix a maximum limit which is tolerable, which is above the minimum threshold limit. He fix that limit. Then he selects a few transactions in each area of audit to be checked. Then he verifies certain selected transaction, that is 100% by verifying accounting aspects, internal control aspects, documentation, audit trail. He verifies 100% of certain few transactions. Then the audit trail refers to the documents. Audit trail means the documents or the records or the books, files which enable the auditor to trace the transaction from its source till it is summed up and recorded and presented in the accounting report. So in a nutshell, the auditor would start from the scratch. He would analyze a transaction or verify a transaction from its very beginning. Beginning means the area or the point at which that transaction was generated. Auditor would start observing from that area, that particular transaction, to ensure that he understands the entire transaction well. Analysis of the result with maximum tolerable limit. Then he analyzes the result with the maximum tolerable limit, which means that whatever he has verified, he would see whether that verification has been done as per the materiality limit set by the auditor. I mean, the errors should not be increased. The errors should not be more than the materiality limit set by him. So for example, if the auditor has fixed up a materiality limit of 1 lakh rupees, then all the errors which comes up during this detailed examination should be below 1 lakh rupees. If they are above 1 lakh rupees, then auditor would definitely qualify his auditor report, and he would have an observation in the auditor's report that there are certain material discrepancies which were found out by the auditor during the walkthrough or the in-depth analysis. Now guys, the downside of in-depth analysis is that in-depth analysis cannot be done for entire transaction, all the transactions, because in-depth analysis requires a lot of time. So in-depth analysis can be done only for quite few selected transactions, and not for all the transactions. So the next topic is differentiate between test checking and statistical sampling. So guys, as I've already told you that it is not practically possible for any auditor to check all the transactions of a company fully. So it has to necessarily employ certain procedures which will help him to select what transactions would he check and what transactions would he leave. So there are two ways in which an auditor can pick out certain samples which he will check, because he cannot check the entire transactions. So the two methods are, number one is test checking and the number two is statistical sampling. Guys, test checking involves selecting certain transactions, selected transactions which are to be verified, and same is the selection of statistical sampling. It is drawing sample from large number of transactions. Both means the same. Test checking also means the same, that certain selective transactions are verified, and statistical sampling also has the same selection objective to verify certain transactions from a large number of transactions. Technique is, no specific technique is used, which means test checking is a random method of picking out samples. So auditor on his own will pick out certain samples, that is test checking. However, in case of statistical sampling, the sampling is done on a random basis but on statistical measures. Statistical measures means there are certain procedures of statistics which are to be employed while picking up samples for statistical sampling, and so the statistical sampling bit is selection of transactions, but absolutely randomly, where the auditor will not have any discretion of identifying which transaction to choose and which transaction not to choose. Guys, in case of test checking, that is random sampling, the auditor can involve into some fraud with management, and the auditor can pick up those transactions which are asked by the management itself. So test checking becomes a little risky. However, statistical sampling is not done by the auditor, it is done by the system, the software. Hence, statistical sampling is much more error-free or fraud-free. Subjective, it is subjective and depends upon choice of the auditor. However, statistical sampling depends on the statistical technique employed. Risk and methods, it involves more risk and there are no specific methods for test checking. It is just a random selection of some samples. And statistical sampling carries out lesser risk and various statistical methods can be used at different times. So statistical sampling is much more scientific, is much more logical, and is much more rational as compared to test checking. So guys, most of the big fours, which are pioneers in auditing an organization, use statistical sampling while picking up samples for their audit. They do not use test checking, or they do not allow the auditor to have his say or have his discretion in picking up the samples. Now, let's come on to the next aspect, which is the internal controls. Guys, we have studied internal checks. Now we'll come to internal control. I hope you remember that internal control consists of two parts. One is internal check and another is internal audit. So internal control system comprises all the methods and procedures adopted to assist in achieving of objective of efficient conduct of business. Conduct of business is efficient, and that is the objective of internal control. Then it ensures adherence to management policies. Management policies should be adhered properly. Safeguarding of assets. Now, assets should not be stolen. Assets should not be siphoned off. Assets should not be misappropriated. Therefore, this is one of the most important objective of setting an internal control, that the management or the employees should not misappropriate the assets. Then prevention and detection of errors and frauds. Of course, this is one of the major elements or major objectives of internal control system. Checking accuracy and completeness of the accounting records. Accounting records are accurately made and completely made. This is checked by internal control system. Internal checks and internal audit are integral part of overall internal control system. What are the essential elements of internal control system? How would a management employ a good internal control system? Guys, first of all, financial and other organizational plans. The internal control starts with planning. Soon as you have a plan in your mind about your business, plan related to operations, plan related to finance, you have to employ good people, right people on those jobs, and those people should be accountable to their seniors. So authority and responsibility should be delegated at the time when planning is being done, and that is the first step of every internal control, because control starts at the planning stage. Second is competent personnel. Your people should be competent and efficient and honest, and they should have integrity while performing jobs. So competent personnel is the second essential element of internal control system. Division of work should be divided amongst the employees properly. That is the third aspect of internal control system. No employee should be allowed to carry out a single transaction all by himself. The transaction should involve many people before it is completed, so that work of one person is checked by another person. Separation of operational responsibility from record keeping. Now, a person who is recording the transaction in the books of accounts should be absolutely different from the person who is actually undertaking this transaction. So these two people should be different people. That is one of the prime requirements of a good internal control system. Separation of custody of assets from accounting. Again, just like the operations people are different and accounting people are different, the assets should be under the control of some other person, and assets should be recorded or accounted for by another person. There should be separation of custody of assets from accounting. Authorization. Every transaction should have a proper authorization. That is, all the activities, all the assets which are being purchased should be authorized by responsible people, and authority should be separately given to each person. Managerial supervision and review. The management should review and supervise the internal control system regularly, and the management should have an environment or have a system whereby the supervision and review happens for every transaction, so that it is ensured that the transactions are not recorded erroneously. The transaction should not have any error in it. So next is, what are the objectives of internal control? The objectives of internal control. Why do we employ internal control in any organization, guys? First is compliance. The compliance should be done for law and accounting practices properly. Everyone should follow the law which is prevalent in the country. Then reliance on the financial systems, reliance on the people, accounting records. All these reliance are strong only when there are strong internal controls. Security. It is secured, your security of your money, security of your assets, security of your entire financial statements happen only when you have strong internal control system. Then is increased efficiency. Efficiency is increased. Human resources, performance management, everyone will perform to their best possible extent if there are proper internal controls prevalent. If internal controls are not there, then human resource will be lured to ill perform or not perform up to their standards. Review and correction happens in a timely manner. Authorization takes place properly. Every transaction happens only with authority, otherwise it doesn't happen. Delegation of responsibility, division of duties happen if there are proper internal controls. Setting of goals. Goal setting happens only when you have strong internal control systems. You will be able to understand what are your future goals only if you have internal control systems. Conformity with accounting principles. Accounting principles are followed properly. Evaluation of transaction. Accurate planning. An objective with respect to resources of the organization. Resources are utilized properly. They are safeguarded properly. I mean, the employees cannot steal those assets, or they cannot misappropriate those assets if internal controls are proper. Then safeguarding of assets. Assets are safeguarded. All the accounts, employees, everyone is safeguarded. Policies are foolproof if internal control system is working efficiently. So next topic, what are the advantages and disadvantages of internal control system? These are two pretty easy topic, guys. So I'm leaving these two topics and I'm directly jumping on to a very important topic. What are the types of internal control system? Now, ultimately, the objective of the management is to control or prevent detection of any errors and frauds, and to ensure that the recording in the books of accounts is being done properly and is being done appropriately. So there are various types of internal control systems. There are various types of checks and balances which can be employed by the management in the books of accounts. What are all those types we are going to study in this particular concept? So the first type of control is preventive controls. These are the controls which are designed to discourage errors and irregularities from occurring. So they prevent the mistakes from happening, and they prevent any kind of errors and frauds from creeping in the organization, transactions and financial statements. They are proactive controls. Proactive means before the incidents happen, they control that incidents, that help to ensure that departmental objectives are being met. Examples of preventive controls are segregation of duties, approvals, authorizations, and verifications, security of assets. So these are the three kinds of preventive controls. First is segregation of duty, which means two people should be taking care of one transaction. So if there is a banking transaction, then that should not be held by one person. It should be split between two people, like Mr. A and Mr. B should both take care of the banking transactions. Second is approvals, authorizations, and verifications, guys. Expenditure of a junior should always be approved by a senior. Activity or transactions of a junior should always be approved by the senior. Even the top management, board of directors should take approval of each other while performing any action in the organization. This ensures that any kind of errors and frauds are not crept in the organization. Third is security of assets. Of course, your assets should be secured. They should be dealt with in a manner that records are maintained properly and the assets are safeguarded from any probable theft, any probable breakage or misappropriations. So yes, security of assets is the third limb of preventive controls. The second kind of controls are detective controls. Detective control means that once any error or irregularity has taken place, then after that irregularity has taken place, what are the steps which we can take to detect this misappropriation or this error in the entire transaction? Now, the best way is to review the performance. You have to review and supervise the performance, and you will be able to figure out where controls have lapsed. Reconciliations are one of the very important means of telling if controls have lapsed or not, because if two things are not reconciling, then it is a clear proof that internal control system is weak in an organization. Like you prepare bank reconciliation statement that will present any internal control weaknesses which are there in the organization before the auditor. Then physical inventories, the auditor should actually go in the go down and check what are the inventories which are lying over there. This is known as physical verification, and after physical verification the auditor will be able to know if any control lapse, if any error has crept in while valuing the inventory. Then audits are one very important source of detecting control lapses and detecting control weaknesses. Like internal audit is one of the most important areas of analyzing whether the internal controls are working fine or not. Then corrective controls, once controls have occurred and they have been detected, now you have to ensure that the error does not repeat in future. So those controls which ensure that the errors don't repeat in future are known as corrective controls. They are correction of errors and irregularities as soon as they are detected. Steps in internal control consist of control environment. You should create an environment which is full of control, full of discipline, full of policies and procedures which ensure that transactions do not happen inappropriately. Then you have to assess the risk of every transaction and assess whether this risk is there or not. Then control activities, you have to control the activities which are there in an organization. Information and communication, you have to communicate the irregularities in the information in the transaction to the relevant people at regular intervals. Monitoring, you need to monitor or supervise on a day-to-day basis that these controls are working fine. Now, what are the nature of internal controls? How do you classify internal controls? What are their characteristics? Now, first of all, it is prerequisite of every efficient and effective management, because without an internal control system, the management cannot survive. Management cannot be present when that transaction is happening. Each and every transaction is happening. Management cannot be present over there. So they should ensure that the internal controls are sufficient enough to prevent any errors and frauds in their absence also. So it ensures a efficient and effective management if internal control systems are working fine. The primary responsibility of every management is to establish and maintain an adequate system of internal controls. Then you need to report the deficiencies. Management should report the deficiencies to the people who are charged with governance, that is the high top end officials of an organization. Management should communicate these to the high the top level management. What is the scope of internal controls? Where all are internal controls useful? Guys, entities, organization structure, first of all, the internal control arises from there, because that ensures segregation of duties and authority responsibility relationship. So this is the first element of internal control. This is the scope of internal control. Second is functioning of board of directors. Board of directors are functioning well or not. This is again an element of internal control system. Scope of internal control system will be clearly evidenced if the board of directors are not working fine. Then management philosophy and operating style is the third element of scope of internal control system. What are the responsibility of managements and auditors with respect to internal control? Guys, very simple, as simple as it can get. Management should devise or maintain the internal controls, and auditors should examine and evaluate the internal control. So who will create internal controls? It is management. Who will create internal checks? It is management. And who will evaluate or examine those internal controls? It will be the auditor. So the responsibility of the auditor and the management is clearly demarcated in this respect. Both have to do different functions. What are the techniques of evaluation of internal control? If an auditor needs to check whether internal control is working fine or not, how can he check? Number one, narrative records. Narrative records means auditor can ask questions and get a description of the internal control system, and that is how auditor can know whether the internal controls are working fine or not. Second, checklist. Auditor can prepare a checklist to the people who are doing internal controls in a day-to-day manner, and auditor can give this checklist to the person who's responsible for internal controls, and while the auditor gets answers to those questions which he has raised, he will be able to evaluate whether internal controls are working fine or not. Now, flow charts are pictorial representations of internal control system or authority responsibility relationship. So flow charts is a very important and useful tool to evaluate internal control system by the auditor, and flow charts can be used as a technique for evaluation of internal control system. Then comes internal control questionnaire. Internal control questionnaire means the auditor can ask some relevant questions from the management of the company, and they can respond to those questions, and the auditor will know whether the internal controls are working fine or not. Internal audit. This is the second limb of internal control. First limb is internal check, which we have already studied, and internal audit is the second limb. So to ensure that things are working fine, to ensure that everything is going as per the established standard, the management has to appoint a person who can check whatever is happening in the organization. This is known as internal audit. It is an independent appraisal activity within the organization by the staff of the entity. Guys, the staff of the company only does the internal audit, or it can also be done by a third party, but again that third party is also hired by the management of the company. So strictly speaking, the internal auditors are not independent of the company. They are dependent on the company. Strictly speaking, this is to be kept in mind. Now, 5 areas of scope of internal audit. Where do internal auditors work? Guys, financial and operating information. Of course, financial statements are the first things which an internal auditor see, which an internal auditor can check. Second is laws, policies, plans. Law, whichever relevant statute is there, whichever policy is being created, plans are being created. All these things are checked by the internal auditor. Then assets are to be checked by the internal auditor. Then resources, whatever resources are there with the organization, which means infrastructure, monetary resources, physical resources, all these resources are checked by the internal auditor. Then internal auditor has to see whether the objectives and goals of the operations are being satisfied or performed well or not. Then what are the features of internal audit? Features of internal audit are that it is an independent appraisal conducted by the staff or independent professional. Both can do audit of a particular organization. Review of accounting, financial and other operation controls. Service to the organization. It is conducted as a service to the organization. Organization is taking internal audit service, that it is conducted as a service. Then it intends to furnish, analyze, appraisals, suggestions and informations concerning the activity reviewed by the management. Then internal audit function is a continuous effort. It does not stop. or it does not take place at the end of the year. Internal audit is a continuous process which is happening daily on a daily basis. Functions of internal auditor are that internal audit is an appraisal function, which means it reviews the activities of an organization from standpoint of finance, from standpoint of law, from standpoint of operations, from any other standpoint. So it is an appraisal activity. Second is, it is service to the organization, which means that it is just like taking any service from a third party. It is a service to the organization which is being given, and it is required to ensure that policies are fulfilled. Information it requires to manage effectively is reliable and complete. So information is proper. Then assets are safeguarded. This is the service which is internal audit service which is given to the organization. Internal control system is well defined and internal control system is working efficiently. These are the areas where internal auditor work. Other duties of internal auditor may be with respect to social responsibility, implementation of social responsibility, that is CSR policies should be in place for an organization. It acts as training officer in internal control matters, auditing the information given to the management, particularly interim accounts and management accounting reports, taking a share of external auditor's responsibility, etc. These are the other responsibilities of internal auditor. Now, what is the need of internal audit, guide? This is a very easy topic, so I leave this topic to you, but it is important. Please read both these topics. These are important topics. What are the advantages of internal audit? What is the benefit of internal audit? And what is the need for internal audit? These are quite similar to each other. Now we come on to the last aspect of this topic, which is difference between internal audit and operational audit. So guys, both these words, internal audit and operational audit, are leading to only the same thing, which is to ensure that operations of an organization are done well. The ultimate objective is to ensure that legal formalities are being fulfilled properly. The objective is to ensure that financial statements are being reported in an transparent manner, in a crystal clear manner. So both of these words are synonym to each other, internal audit and operational audit, and both these can be used interchangeably. However, there are certain small differences which are there in these two kind of audit. But let me tell you, while doing internal audit, operational audit is also part of it, and while doing operational audit, internal audit policies are also taken care of or being checked by the auditor. So compliance objective and risk identification process improvement. Internal audit more focuses on compliance with law, with accounting principles and procedures. However, operational audit identifies the risk process improvement objective. Then the focus is financial accounts in case of internal audit, and operational audit focuses on the operations, that is the business. Audit focus, efficiency and improvement focus. Here the focus is that you have to do audit, and here the focus is that you have to improve, suggest measures to improve the efficiency and effectiveness. Transaction based. So internal audit is done as per the transactions which have happened in the organizations, which are recorded in the books of accounts. And operational audit is process based. Operational audit is not bothered with the transactions, it is bothered with the entire process. Policies and procedures focus. The focus of internal audit is on policies and procedures, and focus of operational audit is on risk management. Internal audit focuses on policies, transaction and compliance, and operational audit focuses on goal, strategy and risk management processes. So these are the broad differences between internal audit and operational audit. Okay, so now let us start the second topic or the second aspect of this particular chapter, which is a very important aspect of auditing as a whole. And it is not an understatement to say that this is the basic core of auditing. The core of auditing is vouching and verification. These two aspects are core of auditing. So let us see what are the different procedures in which we are going to do the vouching and verification of assets. So put it very simply, voucher means any substantiating document which proves a particular transaction. So for example, if your mother asked you to buy tomatoes worth 1 kgs, and you would spend 40 rupees to buy those tomatoes, and you did not go to any unregulated market, but you went to a regulated store, which is big bazaar, or some 24/7 kind of a store, which is a regulated store, there you will get a receipt. Your mom will ask for that receipt, and that receipt will be the substantiating document, which will also be known as voucher. So voucher is a piece of substantiating evidence. It is evidencing in form of written record of expenditure, disbursement, or completed transaction. Examples of types of vouchers are cash memo, sales invoice, purchase requisition, purchase invoice, etc. So auditor essentially vouches or audits these entire documentation, which is known as vouching. Second is types of vouchers. What are the types of vouchers? Original or collateral vouchers. Original vouchers are the primary vouchers, which are invoices and which are documents which substantiate a particular transaction. And collateral vouchers are the supporting documents which support a particular transaction. So I'll give you an example. Now, if there is an expenditure of a director who's traveling to USA for some official work, invoice of the airlines will be the substantiating evidence. Primary voucher for you, you will be studying the invoice of the travel agent who has raised the invoice on you. The secondary evidence will be the boarding pass of the director. It will prove that yes, director had traveled to UK and it is not a bogus expenditure. So along with original vouchers, you also see collateral vouchers, which are the secondary vouchers. Next is internal and external vouchers. Internal vouchers are vouchers that may generate inside the company. For example, in case of a sales, the sales invoice is generated by the company itself. However, in case of purchases, the invoice is generated by the party who is selling the goods to you. So if the voucher is generated from a third party that is outside the organization, it is known as external voucher. And if the voucher is being generated from inside the organization, it is known as internal voucher. Of course, internal vouchers are less reliable because it is being generated within the company, and external vouchers are more reliable than internal vouchers. Then there are certain missing vouchers. Missing vouchers means so generally documents should be serially numbered. All the sales invoices, whatever sales you are doing, should be serially numbered. If those serial numbers are missing, then those vouchers are known as missing vouchers, and the auditor gets a clue that something is going wrong within the organization if there are missing vouchers which are not explained by the management. So these are the types of vouchers. Now, what is vouching? Vouching is an activity which is the activity of checking voucher. Vouching is examination by the auditor of all documentary evidences. So checking the documentary evidences is vouching to support the authenticity of the transaction. Basic objective is to establish authenticity of the transaction recorded in the primary books of accounts. Vouching is said to be essence of auditing, or may be termed as backbone of auditing. So this is an important statement, guys, which you should remember, that vouching is the basis, or vouching is the essence, or vouching is the backbone of auditing. Now you are going to see this payment voucher, guys, and I have already created a video on this payment voucher, which you can see on the I button above. Please see this video in which I have in detailed referred to this payment voucher and have told you the techniques of filling this payment voucher in that particular video. Next is teaming, lading and lapping. This is a kind of fraud which happens in a company in case of which are detected while vouching. So this is a fraud which relates to misappropriation of cash. So whenever a person or a accountant or a cashier wants to misappropriate cash, it can employ this technique of teaming and lading and lapping. What is this technique? This technique is used to conceal the cash shortages and covering them through recoveries from another customer. So for example, let's see the example and understand what is teaming, lading and lapping. A salesman recovers 10,000 rupees from customer C. So salesman recovers some money from customer C. Customer C is the person who has bought goods from your company and misappropriates the same, but to conceal the misappropriation, he declares rupees 10,000 received later from another customer D as received from C. So the salesman takes away this 10,000 to his home and do not tell it to the company. But later on, when Mr. D pays the money, the salesman appropriates that money to Mr. C's account. So that balance of Mr. C confirms to client's debtor list, and so on for recovery from E. Now when E gives the payment, then the salesman says that this recovery has been done from customer D. This goes on and on and on till the time the employee resigns, and one fine day employee resigns and goes away from the company when this fraud comes into picture. Negligence on part of the management and weaknesses in the internal checks or controls may lead to substantial amounts being misappropriated by the cashier. This may result in a huge loss. This is known as teaming and lading error. And audit steps to detect teaming and lading error. The very first audit step is that any missing voucher should be disclosed to the auditor, and it should be carefully scrutinized that why any missing voucher is there. So if number is 1, 2, 3, 4, 5, then fourth number memo should also be there, and there should not be any missing vouchers. Reconciliation is an essential element of teaming and lading error and fraud. You should reconcile your receipts with the cash books, and this reconciliation will present any irregularity which is there in the cash register. Then pay-in slips and counterfoils should be matched. So while depositing money to bank, the pay-in slips should be filled and it should be reconciled with the cash book and cash memos. Cash receipts should be deposited in the bank on a timely manner. And debtors ledger, especially entries showing part payment to satisfy the debtors concerned, have indeed made the part payments. So debtors ledger, wherever debtors you have recovered the amount from the debtors, you should reconcile the entries properly, and you should check whether the debtor who has paid the amount to the company is the same person from whom the amount has been recovered. So debtor ledger should be carefully scrutinized. Confirmations should be obtained from the debtors from time to time. Debtor should be able to tell you whether the amount has been paid by the debtor or it has been not paid by the debtor. So these are confirmations which are essential to reduce the teaming and lading frauds. Now there are certain steps for auditing of receipts, whatever cash receipts or sales of assets receipts can be of two types. It can be due to cash sales, it can be due to sales of asset. So guys, whenever you want to audit receipts, you have to follow certain things. Like first of all, authorization should be there for receiving the cash. Sales should be done by authorized representative of the company and the salesman. So authorization should be there. Then you have to examine few bills and ensure that the rate, amount and discount which are there in the invoice are put in properly. Cash summary book shall be reconciled with the transactions which are happening on a day-to-day basis. So cash sales summary book should be carefully scrutinized by the auditor. Cash sales should be verified with the cash memos. Cash memos should be checked and they should be reconciled with the cash book or cash register to ensure that all the cash sales have been recorded properly. Ensure that cash entry made in cash book is with reference to date on memos. Then you need to verify bank statements for ensuring that the cash which is collected is duly deposited in the banks. Examine the cancelled memo. If there are any cancelled memo, you have to examine them and you have to reconcile them with the original copy. Then what about sales of asset? If there is any money which is received on selling of an asset, then what you should do for that? Again guys, authorization is the primary step. You should be the employees who are selling the assets should be authorized by the board of directors to do so. Second is that if you are selling the assets through an agent, and in case of direct sales, whatever, then you should examine the terms and conditions with the agents, and you should ensure that the amount which is collected is as per the agreement between the agent and the company. Sales value of the asset is reasonable. You should not sell an asset at throwaway prices. This should be ensured. Then duly accounted for, whatever sale has happened, it should be accounted for in the books of accounts, and loss and profit should be recorded in the financial statements. You should ensure that. Now comes on to a very important aspect. What is the procedure of audit of an expenditure? Guys, again, audit of an expenditure is treated as if you are just vouching any expenditure. So the first step would be to see whether the expenditure has been done by authorized person or not. Then you have to see whether proper documentation, which is vouchers, are present for that particular expenditure or not. You have to, in certain cases, see if Companies Act provisions are being fulfilled. All these things are to be checked by you. So authorization, ownership, in case of assets, ownership should be with the company. Existence of assets, compliance is there with Companies Act. Capitalization of assets, all these things should be checked while vouching for expenses. Guys, while vouching for assets and liabilities, you have to check their physical existence, that yes, it is not that the assets has been only procured on papers, they should be existing in the company as well. Title, existence, possession, whether they are overstated or understated, their value should be disclosed properly. This thing should also be carefully scrutinized in verification of assets and liabilities. What is the importance of verification? And now I'll tell you guys a basic difference between verification and vouching. So vouching relates to seeing only the documentation which is existing for a particular transaction. But verification means to actually go inside the factory. The auditor will visit the factory and he will see if the fixed assets actually exist over there or not. So verification is a much more detailed process rather than vouching, and vouching relates or confines to only documentation. Verification actually mobilizes the auditor's movement inside the factory, and the auditor ensures that the assets are actually existing. Then what is the importance of verification? Importance is that true and fair view is given in the balance sheet. Valuation is done properly for every asset. An asset is disclosed at the true value. Any omission, any thing which is remaining to be disclosed is not there if verification happens. Scope of verification, it is done to ensure the existence of assets. Then purpose of business only should be there. Proper authority should be there. Ownership of assets should be with the company, free from any charge. Charge means any mortgage. The loans should not be securitized by the assets, and if they are securitized by the assets, then assets should be disclosed as mortgaged assets or charged assets. They should not be disclosed as free assets. Then assets are valued and disclosed properly. Objectives of verification, again, true and fair view, existence, ownership and title, valuation of assets should be proper, arithmetical accuracy should be proper, recorded properly, direct error and fraud, etc. Advantages, same. This is a very important topic, guys. Techniques of verification. So verification can be done by inspection, observation or confirmation. Inspection means the auditor physically visits the factory premises and sees the physical existence of a particular asset. Observes means he witnesses the physical verification of a particular asset. So the verification is done by the management, and auditor just goes there and just observes that physical verification is happening properly. In case of inspection, the auditor himself verifies the particular asset. In case of observation, management is actually inspecting the assets, and the auditor is only observing it. Next is confirmation. So sometimes the assets of the company are kept at a third party's place. For example, leasing company leases out their assets to third parties. In that case, a confirmation from the third party can serve as a valid document of verification. The auditor need not physically go to the third party's premises to verify a particular asset. How to conduct verification work? So verification work, it starts with documentary evidence, which is vouching. Vouching is the first step of verification. Then you verify opening balance from schedule of fixed assets. Then you verify the acquisition, which is done during the course of the audit, during the course of year. What all new assets have been purchased, you check that. You check the self-constructed assets and whether they are valued properly or not. Then you ensure that fully written off assets are properly recorded. Authority of disposal, the assets which are disposed of, that is which are sold, there was proper authority of those assets. Similarly, proper procedure to ascertain omissions, verify ownership of fixed asset on the basis of title deeds, existence of asset is verified. On a test check basis, physical verification reports are gathered for assets, because assets are nothing but physical tangible goods which are kept in your company. So if I verify those assets physically, then that serves as a good purpose of verification. See whether the assets are charged. Charged means again mortgaged. You should not have mortgaged assets, and if you have mortgaged assets, then you have to disclose them in your balance sheet. So you should ensure that. So that is all about chapter number 3, guys. And yes, it's an important chapter, more than chapter number 1 and 2, because it holds more weightage in your examination. So yes, that's all for this audit marathon. And if you are not able to understand any aspect of this particular chapter, because obviously guys, this is a revisionary video where I'll be quickly going through the chapters. So if you are not able to understand any particular aspect, please call me up on my number and I will explain you that particular aspect. But yes, from an exam perspective, this is an important chapter. So that's all in this marathon, and we'll meet in the next one with the next chapter, which is companies audit, which is one of the very important chapters of our syllabus. Till that time, all the very best and happy studying. For latest updates and information on entire CMA profession, just subscribe to our channel and don't forget to press the bell icon to get notification on the latest videos which are being uploaded on the channel. For products related to paper number 19, paper number 20 for final students and paper number 12 for intermediate students, log on to www.agrawallawhouse.com. It contains the compilation of handwritten notes, books, reference materials and video lectures of these 3 subjects. If you have any further query or you want to speak to me personally for any kind of counseling, you can call me at the number given on the screen.